This LOS is describe mechanisms available for issuing bonds in primary markets. Primary and secondary bond markets. Primary bond markets are markets in which issuers initially sell bonds to investors to raise capital. In contrast, secondary bond markets are markets in which existing bonds are subsequently traded among investors. A bond issue can be sold via a public offering or public offer, in which any member of the public may buy the bonds, or via a private placement in which only a selected investor or group of investors may buy the bonds. First, we'll look at public offerings. In an underwritten offering, also called a firm commitment offering, the investment bank guarantees the sale of the bond at an offering price that is negotiated with the issuer. Thus, the investment bank, called the underwriter, takes the risk associated with selling the bonds. In contrast, in a best effort offering, the investment bank only serves as a broker. It only tries to sell the bond issue at the negotiated offering price if it is able to do so for a commission. Continuing with primary and secondary bond markets, public bond issuing mechanisms include underwritten offerings, best effort offerings, shelf registrations, and auctions. When an investment bank underwrites a bond issue, it buys the entire issue and it takes the risk of reselling it to investors or dealers. In contrast, in a best efforts offering, the investment bank serves only as a broker and sells the bond issue only if it is able to do so. So we saw that in the previous slide. Underwritten and best effort offerings are frequently used in the issuance of corporate bonds. So the underwriting process typically includes 6 phases. The first phase is the determination of the funding needs. The second phase is the selection of the underwriter. The third phase is the structuring and announcement of the bond offering. The fourth phase is the pricing. The fifth phase is the issuance. And finally, the sixth phase is the closing. A shelf registration is a method for issuing securities in which the issuer files a single document with regulators that describes and allows for a range of future issuances. An auction is a public offering method that involves bidding, and that is helpful in providing price discovery and in allocating securities. It is frequently used in the issuance of sovereign bonds. Okay? Most bonds are traded in over-the-counter markets, OTC, and institutional investors are the major buyers and sellers of bonds in secondary markets. A quick practice question to check our understanding. U.S. Treasury bonds are typically sold to the public via A, auction, B, primary dealer, or C, secondary bond market. Okay, A is correct. U.S. Treasury bonds are typically sold to the public via an auction. Okay, B is incorrect because primary dealers are often bidders in the auction. They are financial institutions that are active in trading U.S. Treasury bonds. Okay, and C is incorrect because any bond issue coming directly to the market is considered to be in the primary, not the secondary bond market. And one last practice question to finish this LOS. An investment bank that underwrites a bond issue, most likely A, buys and resells the newly issued bonds to the investors or dealers. B, acts as a broker and receives a commission for selling the bonds to investors. Or C, incurs less risk associated with selling the bonds than in a best efforts offering. Now that should have been a pretty easy question to finish on. An investment bank that underwrites a bond issue, most likely A, buys and resells the newly issued bonds to investors or dealers. In an underwritten offering, also called firm commitment offering, the investment bank, called the underwriter, guarantees the sale of the bond issue at an offering price that is negotiated with the issuer. Thus, the underwriter takes the risk of buying the newly issued bonds from the issuer and then reselling them to investors or to dealers who then sell them to investors. And that's the last slide for this LOS. Thank you.